Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So Netflix has been one of the most successful stock investments of the last 20 years. If you had invested $10,000 in Netflix at its IPO, that would be worth somewhere in the ballpark of around $3.5 million today. But what really matters for investors moving forward is what Netflix does in the future. So that's what we're going to focus on today. We're going to go through an analysis of Netflix and run through kind of my thoughts of the current business model. Does it have a competitive advantage? How good is the management? Are we able to pick up the shares at a reasonable valuation? And my overall opinion on what I think Netflix is going to look like as an investment moving forward. Now, before we get into the video, I must say that I'm not a registered financial advisor, and this is certainly for entertainment purposes only. So please don't take any investment actions as a result of watching this video. But a lot of you have been keen to hear my thoughts and my process generally on how I kind of look at any company. So that's what I'm keen to share with you today. So let's get into it. This video is essentially going to be split into 4 sections. So we're going to do a quick 4M analysis of Netflix: the meaning, the moat, the management, and the margin of safety or the valuation of Netflix. So we're going to start out with meaning, which essentially means, do we understand the business? Fortunately, this one for Netflix gets a pretty easy tick for most of us. So I'm sure many of you watching this video are already Netflix customers, and you will know that they are the global leader in streaming services around the world. They stream both original and licensed content from other companies. They recently clocked in at 183 million subscribers in their latest quarterly report. And fun fact, they happen to account for around 15% of all internet use across the entire planet. So Netflix is a very simple business. They essentially sell subscription services to their streaming platform, and those are monthly subscriptions, which you and I pay probably every month. So very simple business. So for meaning, we get a tick. Let's move on to the moat and figure out whether Netflix has a competitive advantage. So I'm going to be referencing some notes here just to make sure that I don't miss anything, but we all essentially know that Netflix is the worldwide leader in streaming services. They have had phenomenal growth over the last few years, which we'll get into shortly when we start talking about the numbers and the valuation, but nonetheless, they've had phenomenal growth, and that suggests to me that there is something that is really fueling that and driving Netflix ahead of its competitors. And there's got to be some reason why other competitors haven't been able to yet reach the scale that Netflix has. And I think one of the main reasons that Netflix has been able to do this is they were the first company to try and tackle streaming seriously. They've been in the streaming game since 2007, which is far, far earlier than a lot of companies have done. We saw Disney Plus, for example, only get launched late last year in 2019. So they've had a 12-year runway to get to scale that some of these other businesses just have not had. And one of the great things about the Netflix model that can fuel their growth even further is something called a network effect. So we see this with something like the Facebook business. So the Facebook platform is a very attractive proposition for customers because all of their friends are using it. And the more of your friends that are using a certain social media platform, the more interesting and more valuable it becomes. And that sort of snowballs to a point to where all of a sudden everyone is on Facebook or everyone is on Instagram, and you don't really want to go and use the MySpaces of the world anymore because more and more people are moving to this platform, and the value proposition becomes more and more attractive. Now, we have something kind of similar happening with Netflix. So since Netflix was a very early business in the streaming game, they were able to start generating revenues much earlier than other companies. And essentially, the more revenue that they generated, the more they were starting to be able to produce not only their own content, but also license other companies' content. And again, that started to snowball. So since they had more content on the Netflix platform, they could then bring in more revenue, spend more money on growing the platform, bring in more revenue, and the cycle sort of just continues now to the point where they've become a massive industry leader in this space. And that has also allowed them to do a couple of things that demonstrate to me that they do have real brand power and power to outcompete other companies. And the big one, which happened around 18 months ago now, is Netflix actually went around and increased their subscription prices by anywhere from about 13 to 18%. So that happened in about January 2019. And that really didn't impact their subscriber number growth at all. So it shows that they have pricing power over Jim's streaming service and some random other streaming service that is trying to get started. And that's great in terms of the long-term growth and long-term competitive advantage of Netflix. Now, there's a couple of things I would be amiss not to mention here with the moat and the sort of competitive landscape that Netflix plays in, and that is the introduction of newer streaming services. So Netflix, as we've discussed, has had a long runway of growth and really very few serious competitors up against them. And for the first time, as of last year, we're starting to get some serious competition come in to compete against Netflix. And that is a service by the name of Disney Plus, which I'm sure many of you will be familiar with. Now, Disney Plus has a couple of impacts for Netflix. The first one with Disney Plus is just straight up competition. So Disney Plus and Netflix are now competing for many of the same dollars from the consumer that they would spend on entertainment in their monthly budgets. And I know many people will go ahead and have both Netflix and Disney Plus, but there's certainly plenty of consumers out here that will make the switch, particularly if they have young children, and the content is really just much more suitable on Disney Plus versus Netflix. So that's the first thing. The second thing with Disney Plus is, previous to Disney Plus being a thing, there were actually a lot of Disney shows and also not so much Disney branded shows, but shows that the Disney company also owned that were available on Netflix. Now, obviously, now that Disney has their own streaming platform, that's probably not going to be a thing anymore. And all of that Disney content has now actually been stripped out of the next Netflix platform, which is just another thing that makes Netflix slightly less attractive to the consumer. So if you were to go ahead and make an investment in Netflix, that would certainly be something to keep an eye on, is how is the actual content on the platform changing, and are people starting to switch across multiple platforms, and how is that impacting subscriber growth? So for now and up until this point, they have had phenomenal competitive advantages. Whether that persists in the future, we'll just have to wait and see. The third M in our analysis is management. So who is actually in there running the company, and are they aligned in terms of their incentives with shareholders? So what we don't want is someone that is just going to grow a company for growth's sake and try to increase their salaries and not really have shareholder interests at mind. Ideally, we want someone with a big shareholding in the company, someone who's been around a long time, and that's basically exactly what you get with Netflix. So Netflix is run by the co-founder Reed Hastings. Reed has been at the company since it was first founded in the 90s, in 1998, and he has a massive shareholding in the company. So his base salary is very, very modest compared to a lot of corporate American CEOs. It's certainly many multiples of what the average person obviously makes, but compared to many CEOs in the States, his base salary is not anything super extravagant. What is extravagant, however, is his stock-based compensation. So he's heavily incentivized for having the stock perform very, very well. Great to see a founder still heading up the company after all this time. So there's certainly a tick there from me. So that's kind of the people side of management. The other side of management that I often like to look at is how are they performing with the financials. So we look at a couple of things there. Return on equity is a big one. So relative to the equity within the business, are they producing high returns on that and doing a good job with our money as shareholders that's in the business? And the other thing is debt. So debt can kill a company very, very quickly, as you're seeing with some of the airline and travel businesses in the world at the moment. So it's certainly something that we want to keep an eye on as well. Now, in terms of these couple of metrics, return on equity for Netflix is through the roof. It's right around 30% at the moment, which is just ridiculously high and very, very good. So not too much more to say on that. But debt for Netflix has been an absolute killer, and I really want to dive into some of the details for this when we get into actually valuing the Netflix business, because it is actually a pretty interesting one from a valuation perspective. So the high level kind of overview of what's happening with the debt at Netflix at the moment is that debt has snowballed from $3.3 billion in long-term debt to 14.7 billion in only 3 years. These are the first 3 M's for the Netflix business. We've gone through the meaning, we've gone through the moat, and we've gone through the management. And the final piece of the puzzle for me as a value investor and someone that wants to buy companies at significant discounts to intrinsic value, we have to talk about valuation. And Netflix is a weird one. So Netflix is a very strange company to look at financial statements for, because of a couple of kind of key characteristics of the business. So if you look at some surface level numbers on revenue and earnings for Netflix, so this is what you'd see on a profit and loss or income statement, the numbers look just spectacular. So since 2016, we have seen annualized growth in revenue of over 35% a year. Revenue has grown from around $8 billion in 2016 right up to north of $20 billion in 2019. Just spectacular growth. And the story with earnings has been even more spectacular. We've seen earnings grow from about 180 million in 2016 up to about 1.8 billion in 2019, and that is over 100% per year growth to get to that point. It's just ridiculous rates of growth. So if you're purely just to look at the income statement and those 2 numbers, things look incredible, and the Netflix business looks like it is doing no wrong, and it is just going to grow into infinity, and you should pay a huge amount of money for the business and all that kind of stuff. And largely that's probably what's reflected in the stock price at the moment. But I want to get into a few key things that I think a lot of people miss by just looking at those surface level numbers. Now, one of the reasons that revenue and earnings look so spectacular with Netflix, or earnings more specifically, is that there is a significant expense for the Netflix business which is quite consistent and actually growing, that's not actually present on the income statement, and that is capital expenditure on creating new content. So the reason that that expense is not included in the profit and loss or in the income statement is the fact that it can be classed as a capital expenditure. And it is a capital expenditure in one way, and it's kind of not in my mind in another. So the reason that you can class these big expenses to create new shows and do all these things as a capital expenditure is it is a one-off event in some way. So you spend all this money, for example, to create the show 13 Reasons Why. You don't have to spend that money a second time to create 13 Reasons Why again and still have it there the next year. You only have to film it once, and it's there forever, and people can watch it as much as they like out into the future. So in that way, it is sort of a one-off cost, and it's a one-off capital expenditure. In another way, the need to create new content, I don't think is ever going to go away for Netflix. So if Netflix just completely cut all spending on creating new shows today, I think they'd probably be fine for a few months, or maybe even a year or a couple of years, maybe. But really, in my mind, they need to keep creating more content and more content and more content. And like we kind of talked with in the network effects, as we get more people on there and we get other competitors coming in also creating their own content, I don't really think Netflix can slow down at all and kind of slow these capital expenditures. So in my mind, it's not like Tesla, for example, where they spend some money up front to create a factory which is classed as capital expenditure, and then they can just keep pumping cars out of that factory. In my mind, for Netflix, this expense is going to be pretty well permanent, if not grow into the future, kind of as their subscriber numbers grow. And this kind of trend is captured pretty well when you look at the other 2 financial statements. So when you look at the cash flow statement, you will see that cash flow from operations for Netflix is massively negative. And when you look at free cash flow and start to include all those capital expenditures, you'll see that for 2019, the free cash flow for Netflix, which is often figures that you use in a discounted cash flow to get an indication of what kind of cash is available for owners and what that will look like out into the future. That number for Netflix is negative more than $3 billion. And that negative $3 billion is the highest it's ever been, and that it was still negative in 2018, but a smaller amount, and still negative in 2017, but a smaller amount. So moving through time, that negative free cash flow has got just more and more negative. So that's what we see on the cash flow statement. And then if we look over on the balance sheet for Netflix, we start to see the impacts of this on the long-term debt of the business. So like I said earlier on, we've had more than a 5x in long-term debt over just 3 years, and that trend really has no sign of slowing down. And management have openly come out and said that we don't see a time in the foreseeable future where cash flow is going to turn positive. So that then begs the question, how the heck do we go about actually valuing this Netflix business? And for me, I care about owner earnings and cash flow. That is what is important to me as an investor. If I go out and buy a certain investment, I want that investment to return cash to me over time. That doesn't necessarily mean I want a dividend every year or anything like that. If they can put those profits to work at an effective rate within the business, I'm more than happy for a business to keep profits. But over the long term, the value of any business is equal to the amount of cash that they can return to me as a shareholder, discounted at an appropriate rate. So if we put that into practice in something like a discounted cash flow model, and we use negative numbers basically out into infinity, we're going to get a negative intrinsic value. AKA the company is worth zero if they don't change anything out into the future. So that's kind of my thoughts on valuation. We could be mega optimistic and use earnings as a good proxy for owner cash flow and what can eventually be returned to owners. And frankly, if we even use earnings, which is in my mind not a good representation of what the Netflix business actually makes, even if we put that into a discounted cash flow model and use earnings as a proxy, kind of the best possible view of the performance of Netflix that we possibly can, the numbers still come out that Netflix is actually quite significantly overvalued. So I'll put up some screenshots here of the enterprise value that I think is a fair price to pay for Netflix, if those earnings were a good representation of how the business is going, versus the current enterprise value, and you'll see that the current enterprise value is actually at quite a premium to the number I get there. And that is not a number I'd be comfortable working off. That's just to prove a point that even if you be as optimistic as possible about how you think sort of financial reality looks for this business, I still think it's overvalued. So to sum things up, I think Netflix has a great product. I'm going to be a subscriber of it for a long time personally, I am sure. I just think the business model sucks. So they're sort of caught in this trap where they have been producing better and better content over a period of time for a long time, and it's had the great impact of growing subscriber numbers very, very successfully. But in terms of that producing cash that is available to return money to your shareholders, it just does not look that good. So for me personally, I'll be a customer of Netflix for a long, long time, unless they all of a sudden do try to cut their spending on creating new content. But from an investment perspective, it is just an easy pass for me. So I hope you enjoyed the video. It's definitely an interesting one from a valuation perspective and trying to get your head around kind of financial reality for the business. So I do hope you enjoyed that and you got something out of it. Again, not financial advice, that's just sort of my thoughts on what the company's doing, but I hope you enjoyed the video nonetheless. If you did, hit like, hit subscribe. You can watch some older videos over there. Hit subscribe over there. Otherwise, I will see you in the next one. Cheers.